Hello everyone, I'm Ted Oakley, Managing Partner at Oxbow, and I'm really excited today to be interviewing Julian Brigden. Julian is the co-founder of MI2 Partners, and he has been so interesting over the years to look at what he's doing and what he's bringing out. He has a great presentation today for us, and at the end, I have some great questions for him, which are very interesting to listen to as well. But Julian, I want to thank you for being here and welcome to the Oxbow presentation.
Hello. So I think as we all sit here, we all know that this is potentially, excuse me, quite an extraordinary period that we live in. And I think certainly challenging for what Ted and his team do in terms of wealth preservation. Let's put it like that. I think that's the MO of the next 3 years. We've made lots of money in the bull market. Let's see if we can preserve it and hopefully make a bit on the way. But I want to pose a question to you because I think it's a question that a number of people are potentially asking. And I think people, particularly in your space, need to really get your heads around. And that is the idea of, are we coming to the end of what is, euphemistically referred to as the Great Moderation? And we've seen various events that have transpired around that. We've seen basically some very significant market trends that have been built around that. And I think this is fundamental to managing money going forward. So as we sort of kick things off, the first thing to do is define essentially what we mean by the Great Moderation. And that is essentially a period, and you can see it in this slide here with GDP in white, of sort of reduced macroeconomic volatility starting really in the mid-1980s. So here you've got nominal GDP year over year, and this is basically real GDP plus inflation. And that you can see post-1985, with the exception of the global financial crisis and COVID, the amplitude of the economic swings significantly declined from the immediate post-war period, it's allowing us to escape this purgatory that we would refer to as the sort of boom-bust cycles that had dominated the economy for most of the part of that post-war period. Now, beyond the lower volatility in GDP, what marked this period was a very clear trend in lower inflation. And this was driven by two primary factors. The first one is the emergence of a peace dividend following the collapse of the Berlin Wall. You can see this here in 1989, and certainly Ted and I will remember that. Many of you on this call may not. You might have been still in shorts. But the reality of the situation is that's what initiated the end of the Cold War. And amongst other things, it freed up capital to pursue more productive uses outside defense, and thereby helped to drive technological change. Secondly, it initiated a period of globalization. Firstly, as the communist states started to open up and tension receded. And then this was turbocharged by China's joining of the WTO in 2001. And you can see that this corresponded with a period of significantly structurally lower inflation. Less volatile economic cycles and lower inflation in turn fueled three clear trends. Now, first one I've already mentioned, that's the end of the boom-bust cycle. The second one is because the cycles were so contained and inflation benign, the days when policymakers needed to aggressively slam on the brakes, something referred to as stop-go economics, were gone. Finally, because volatility was so low, inflation muted, and policy benign, the risk premium demanded by investors to buy long-dated government bonds declined. And this is what you can see in this chart. This is what they refer to as the term risk premium. This is the amount of premium investors demand over and above what they can earn by rolling their money over in the short-term money markets. And you can see, in actual fact, it's currently negative. And this helps to, obviously, this is a metric of Fed credibility, and this helps in part to explain the decline we've seen steadily in bond yields. It's just bonds have been less risky because the world is less volatile. Because the world is less volatile, the cycles are more predictable. Because inflation is in itself structurally lower, policymakers and the policy response function is much more benign, right? A self-reinforcing, lovely cycle. With that, real yields, in other words, nominal yields minus inflation, have also steadily fallen, even dropping into negative territory for most of the past 20 years. Okay? Now, Fed Bernanke once claimed that these outcomes were the result of greater central bank independence. And in fairness, there's no question that Paul Volcker action in 1979 onwards helped stamp out the rot associated with the volatility of the prior 40 years. However, for Ben to claim all the credit is a little self-aggrandizing, to say the least. Furthermore, for someone who claims to be a scholar of history, Ben is overlooking the fact that before the era of modern central banking, we've had numerous periods when the peace dividend has spurred technological advances and an acceleration in trade, which has led to lower economic volatility and lower real rates. And I think, ladies and gentlemen, it's very important to put this into context, right? We tend to become, those of us like myself who sit at a desk and look at screens all day, we can become myopically focused on the minute to minute. But sometimes it's very important to take a step back and to realize that, the world's been around for a long time. Financial markets have been around for a very long time. Yes, they look a little bit more shiny and a little bit more sophisticated, but the fundamental principles have always been there. Is the current great moderation about to end? Destroyed by an inflation and return to economic volatility? And if so, what does it mean? However, I do want to look at the most prolonged bout of inflation ensuing bond bear market that we have seen in our lifetimes. And that is the 1960s into the 1970s, to see if any, we can draw any conclusions. So, as you can see, here is CPI from 1959 to 1982. And what you can see is after a period of nirvana in the late 50s into early 60s, where basically CPI vacillated around 1 to 2%, starting in 1965, prices accelerated over the next 15 years, and we had 4 clear bouts of higher and higher inflation. As we've mentioned, not until Paul Volcker came in 1979, and to use the euphemism, burnt the house down to cook the dinner, okay, did we get to grips with the inflation cycle. So what went wrong? Well, the initial problem started in 1965 with Johnson's Great Society spending, a pro-cyclical fiscal package that overstimulated the economy that was already running at full capacity. And you can see here that inflation broke out above that sort of 1.92% level and went all the way up to 3.8. If that wasn't bad enough, as inflation started to break out, it was turbocharged by accelerating defense spending related to the Vietnam War. Now, in fairness, the politicians weren't the only ones making errors, because aside from the fact that fiscal policy was driving higher inflation, the other problem was excessively easy monetary policy. What should have happened is that as inflation started to rise, which you can see in this top chart here, and bond yields and the bond market started to sell off, the Fed should have increased rates to choke off demand and snuff out price increases. Okay, that was their job. However, Bill Martin, the then Fed chair, believed that the Fed was ultimately, quote, independent within government, but not of government. Therefore, he decided that with the country at war, he couldn't undermine government policy. Hence, they made the conscious decision to accommodate Vietnam spending. And via a program called money debt financing, which ran from 1965 to 1969, and we know as QE, they printed money to buy treasuries. The net result, as you can see from this chart, is that real yields fell, not rose. Okay, even though nominal yields rose throughout that period, because they just didn't get yields to the point where they could tackle inflation, and policy was simply too loose. The result was that inflation broke out of its nice controlled range we showed you before in the early 60s, and it never looked back. Gone were the days where the Fed could act as the nice preemptive regulator of the economic cycle, gently supporting growth at the bottom of a downturn and dampening animal spirits during booms. That's what they should essentially do. I mean, you've got a 1.75% trend GDP growth, and the cycle tends to vacillate around that, and the Fed comes in at the top and taps it down a little bit, comes in at the bottom and gooses it up. But the reality of the situation is once things start to get out of hand, and I think this is the central bank equivalent of trading negative gamma for anyone who understands that particular reference, at situations you end up buying more aggressively at the high and selling more aggressively at the low, and the positions get bigger and bigger. So basically, policy became reactive as central bankers were caught by the strength and then the weaknesses of the economic swings. Hence, rate moves became more and more aggressive, and you can see this here. They hike 275 basis points, and they ease 225, then they hike 650, then they ease 400, then they hike 1,000, then they ease 850, then they hike 1,500. Therefore, rather than dampening the amplitude of the cycle, the Fed actually adds to the vol. Now, for any of you who have any engineering or physics background, you will know that this is the very definition of what is called an accelerative oscillation. So a force applied at the wrong point of a wave or a cycle, rather than dampening that cycle, actually adds to the volatility of that cycle. The cycle gets increasingly out of whack. For those of you who don't know, just think of the Tacoma Bridge, right, where the wind hits at the wrong time, and the cycle just gets bigger and bigger and bigger and bigger until the thing breaks. And this is exactly what can happen in an economy. The result was that we went from a period where we basically hadn't had a recession for a decade to having bouts of inflation and stagflation with 4 recessions in little over a decade. The halcyon period of that low or moderate economic volatility was replaced by boom bust. And if you thought it wasn't bad enough for the economy, investment returns were horrible. Sure, if you look at the top here and you look at nominal returns for the S&P, the bond market, and total returns to the S&P, including dividends. Now, bear in mind that dividends back then were a lot higher. Then you did get positive returns. But in real returns, you got absolutely crushed in everything. Plus, you had 6 bear markets, 20% plus declines, in a little over 15 years. The dollar collapsed, and try surviving that degree of volatility. Well, fast forward to the present day, and I'm afraid I think the parallels are frightening. Yes, the Fed is tightening monetary policy, but despite this, real yields, ladies and gentlemen, haven't been this easy for the last 50 years. And if you want to make some sort of comparison to the Paul Volcker years, real 10-year yields under the first recession that Paul Volcker initiated were just under 8% positive. Okay? Now, the economy is still operating above trend, okay? Unemployment is the tightest it's been since 1969. And we've still got a bunch of FOMC members, even though Powell is extraordinarily hawkish, who are still hell-bent on achieving a soft landing. And there's increasingly talk of division within the board. Right? We can't take, 4.5%, 5%, that'll be enough for rates. Don't worry, it'll all be soft landing, it'll all be easy. So you need to even ask yourself, is Powell really Volcker 2.0? Is this a man who's prepared to inflict enormous pain right now? And I'm not talking about just glancing pain. Enormous pain to get this thing down, to quash inflation now, to take on the pricing power of the US corporate sector, which I believe is singularly the biggest inflation push now and has replaced the unions as the biggest threat as they were in the 70s to inflation. Okay? Before this cycle gets out of control, and I'm not sure he is, but even if he does he really have the ability to face down policymakers and voters? When you look at the US, which has grown very, very fat on the benign, even complicit monetary policy, then the implications are profound. Now, just to finish this up and give you a metric how richly valued the US equity market is, at the highs, the broad US equity market, not just the NASDAQ, the broad US equity market had seen a 5 standard deviation divergence versus the rest of the world. Okay, an event that should only occur every 3.5 million occurrences. So the point is, this is going to have very, very profound implications. Now, maybe, just to find out, maybe Powell's going to do it. And all my policy contacts tell me he's highly determined. But if he is highly determined, do not assume that this is just a glancing blow. He will have to absolutely nail this economy to the floor with materially higher unemployment. In fact, the only recession in the post-war period that delivered the sort of reduction in inflation that we need was that 81-82 recession, where Volcker took rates significantly higher. And by the way, that would probably end up with 7% unemployment. That's roughly what you created back then. So it would not be a soft landing in any way, shape, or form.
So, Julian, let me ask you this, and I've been a person that said for a long time, the last 25 years, that the Federal Reserve has basically ruined the economic cycles of this country. And I think it's really done a disservice to a lot of people. And I know conservatism in the last 2 or 3 years has been thrown out the window, and we've been criticized for it, I would say. But what do you think and what people are thinking? It seems as though a lot of people are still thinking, oh, it'll be okay, the Fed will do this, rates will come back down, we'll be back to normal. Do you find that out there?
I think it's a very interesting question. It's something I've been chewing over recently. I think if you look at the cohorts, I would divide them roughly into sort of 3 camps. The first camp are people like myself, who I would put at about 15% of market participants, who think, while we can't connect all the dots yet, generally the view is that there's a risk now we are in that structural mid-1960s. I would guess we were like 1969 in that kind of cycle that drags on into the 70s. There are certain pieces missing. For example, we don't yet have a materially weaker dollar. We have a very strong dollar. That's obviously what kicked off that third cycle in 1972 was the weakness of the dollar. But I think that people like myself, when you connect the dots and you kind of look at the geopolitics, you look at the demographics, you look at the socioeconomic setup, see a setup that looks probable on balance that we will end up in that structurally inflationary cycle. It doesn't mean you don't get big oscillations, as you saw from those charts, right? In the 60s and 70s, huge oscillations, but structurally inflationary higher. I would put that group at about 15%. 35% shrinking is the group, and is the transitory group. This is all going away. This is just supply constraints. Don't worry. It'll all disappear back into the can, and we can put the lid on inflation and stick it back on the shelf, right? And we'll be back at zero interest rates and negative bond yields and that whole thing. 50%, I think, have increasingly moved, and it's probably the largest growing group, into the, it's not what we thought. There is something underlying here, but don't worry. It won't take a ton to wring this out of the system. The fundamental problems are not so structurally ingrained yet that a stitch in time will save 9 and we'll be fine. Maybe we'll have to get a bit of a slowdown. Maybe we'll have to see a little bit of unemployment, but it'll all come back together. And that's actually not what history suggests at all.
And Julian, I've been around a little longer than you. You've been around a long time, but I've been around a little longer than you. And I will have to say, you mentioned something earlier, but I remember you had a bear market, end of the bear market in 74. Then you had a bear market in 77. You had 20% and 25% declines in 78, 79, 80. And one of the things today with the people in the industry, and I keep mentioning this, is that they've been used to just an easy go type of routine in investing. And I don't think a lot of people have the capacity to make that adjustment. I'm just curious what you think.
I think, even if I look at the professional side of the marketplace, a lot of my clients are macro hedge fund guys, and these guys, are very skilled traders. I mean, I've always found it a little contradictory, and it's not a dig at an Oxbow, but the sort of high net worth management group who tell their clients that you can't possibly time markets, that you need to be in this for the long haul always, right? You can never, we've always got to have the 60-40 allocation, right? They've all grown up in this the 60-40 allocation, 79 kind of Greenspan put era, overlook the fact that there is a whole slew of the industry that all they try and do is market time. And I think those people are in for a challenge. I think their clients are in for an even more challenging period where they discover that their returns are nothing like they thought they were going to be. In fact, they're going to end up losing money potentially, and potentially in their insurance part of the portfolio, which is obviously the sort of bond side potentially. But I think it's going to be very, very tough. Even the macro guys, I have conversations with people at weekends now because they're too busy to talk during the week, and they just sit there and they go, "Oh my goodness, am I exhausted? This market is just wild."
Well, and one of the things that's interesting, at Oxbow, currently we have somewhere between 50 and 60% cash or treasuries, and we have had for a long time.
Right.
And gotten, you get a lot of heat on it after a year like last year because you have to sort of get ready for these things. And I remember early on in January of 21, I believe, you were one of the first out of the box that said, "Hey, we're going to inflate here," and people were saying, "Oh, I don't know about this guy," but you were right on the money.
First report on 5th of January 2021 was inflation, the most important variable of 2021. And the piece that we wrote this year, actually the very, very end of the last report we wrote of 2022, was a return to boom-bust economics, that we think we're going back to that really aggressive cyclicality, I'm afraid.
And let me ask you this question. This is on the, you can see this on the money management side, but a lot of people, and I'll take the bond market first, but a lot of people on the bond side, for example, have just stayed with a skilled portfolio long term that just breaks it down. And our contention is this: and we've had a small portion of longer bonds, but even with a small portion, I'm talking about 6 or 7%, you still get hit because the damage is so hard. that people don't realize. Now, you can keep those to minimums, the sell-offs, so that's for sure. But that's one of the tough parts I think a lot of people have with it. They don't realize that when you get into these periods, I remember back in the time I was in the business, there was a 7-year period that you had, anything you owned had to be less than 48 months.
Right.
If you went any further than that, you're going to lose. In fact, you probably lose a little money on that even, but you could wait it out to maturity.
Right.
Is my point.
Right.
And that's where we are. That's where we look to be now. And I think people don't realize that if what you're saying comes to pass and he stays with it, which is something that portfolio managers have to really sober up and look at, even ourselves, and say, okay, do we want any long-term paper? Even 5%. Do you want any long-term paper? And don't you think that's a question that's going to be really hard for people managing money?
I think it's going to be an extraordinarily difficult question, and I think people forget. I mean, I will be honest, right here, right now, I'm kind of contemplating from a trading perspective to go back into the long end of the bond market. My models are starting to show that in the US, 10-year treasuries are probably about 100 basis points rich right here. What's holding me off? Well, what's holding me off a little bit are events overseas. We've talked to our client base a lot about what we refer to as fungibility. So people don't, particularly as you sit here in the US, you tend to forget the rest of the world. Right? It's a bad trait sometimes, and it can bite you. And I think this is one of the times that it's set to do that. And that is, Americans tend to forget that one of the reasons Treasury yields have been so low, particularly at the long end of the curve, is because of the flow that you've seen from the rest of the world, encouraged by the policies of the ECB or the BOJ and negative interest rates and their QE, right? It's just funneled cash into our bond market. Well, the problem is that their bonds are now under pressure. In Europe, they've got a horribly stagflationary scenario facing up. I don't believe that inflation has peaked there, where I think it has probably on balance. It's going to be sticky here in the US, but it has peaked. And then in Japan, you've got a policy which Governor Kuroda is running, which is totally, really irresponsible. And he's somewhat snookered and caught out by the fact that the currency is weakening, and that's pushing inflation pressure into the economy. We think inflation is going to go very much higher, and it is beginning to show signs of unhinging the long end of the JGB market or their treasury market, with the effect that is they've been huge buyers of particularly actually our mortgage debt. They buy a lot of agency paper. And so there is a risk that if the JGB market starts to become unhinged, that you will start to see further pressure at the long end of the bond market. Against that, I do think we're going to see some weakness in the economy materially start to accelerate. I'm extraordinarily negative not in an 08, 09 kind of way, but in a activity perspective. I'm extraordinarily negative on the outlook for the housing activity in the US. I think we're really going to see that implode, probably starting tomorrow with housing starts. But
Julian, I was going to mention too, I've heard you say this before, and I'll try to get this, but you've said if you overlay the New York Stock Exchange from the low in 09 with the price of, I think you mentioned the price, median price of homes, it's 1 for 1.
Yes.
And that's really interesting.
Yes, I mean, that's why it's, extraordinarily hard to protect your wealth here, right? I mean, if I can reshare a screen. So here you've got the NYSE, which is a pretty broad metric of the US equity market. And here you've got median single family house prices. So, yes, it's a little disconcerting. My models are suggesting at this point a 15% decline in US house prices. Now, that will still leave you up on the pre-pandemic levels, but it could be worse. I mean, since I expect the equity market to the S&P to ultimately go back down to 3,000, we'll see.
But you're using a 3,000 number on the S&P and probably 7 or 8 on the NASDAQ, commensurate?
Something like that. Yeah, I think that's where the excesses really are.
Yeah, I would think so. And, and last question for you, and that is, if you were The average investor we see out there today, particularly over 50 or 55, for us, they seem to have too much equity. They've gotten hooked in the last 10 to 15, 12 years, and they think this is just a blip in 22. Do you feel that way or see that happening?
Yes, I think that's equity or private equity, right? I mean, private equity does worry me quite a lot. Not because I think that the space is wrong, not anything like that. I just think, it's one of the things that we've been concerned about not in yourself, but some of the private client side is the growth of these security-backed lending that we've seen, where people essentially are borrowing against their portfolios. And, super when everything is going up, right? You could go to UBS Wealth and get a 1% loan, against your treasury portfolio, or many cases, your muni portfolio, right? 90% loan to value. Great. I've heard of stories of people financing their, trustafarians, as we would call them, financing their lifestyle on these things.
And Julian, another thing is you can't get, I've said for a long time, they're talking about margin levels, and I keep saying, well, that's not a really good test, because if you look at security-based lending, we don't know what that number is. I've tried to guess at it. I've tried to get it from different places. It's huge, though, because you could borrow at 1 or 1.25 on the, and there's so much money out there like that, and people don't realize, I think, what's there. And the impact, and that hits the wealthy. That's not the little person.
Correct, sir. And that's, when you look at things like the AAII survey, so the American Institute of Individual Investors, that's really what they're measuring. They're not measuring mom and pop, they're measuring your clients, right? And your clients haven't, in aggregate, have not sold their equity holdings, right? They still remain extraordinarily heavily invested.
Well, I have to say ours have.
I know
we're only 40% in.
Yeah, I mean, if you've got that much cash, they've definitively scaled back, but most have not.
Right. Oh, no, questionably. They're exactly the same.
Right, and I think they've got sucked into this private equity stuff, which is now becoming a net cash drain on them, because they're getting these continuous private equity calls because private equity can't issue more debt. At the same time, they've just dodged a bullet because the market has bounced off the low, so they haven't had to make that equity call or that bond. They may have had to make some margin calls on their muni portfolios and treasury portfolios, but we're in this stasis now where these guys are licking some of their wounds. Their cash drain is quite high. You always think of high net worth people having lots of cash around, but the reality, as you well know, is they don't, right? And so I do think that the final shoe in this bear market will come when you get the liquidation of the wealthy investors in the US. Because I do, to your point, look, if I asked you a question, if you were asked what was heading into the peak, I've got my views, what was the average allocation to US equities in a portfolio? It was probably, I was told, like 85%, right? And 15 maybe overseas. And shouldn't be that high. It should be 65-35. And then you ask, within that 85, what was the allocation to tech? And it was the vast majority, right? Because we became momentum chasers, and it's all great. But unfortunately, as you and I were around in 2000, we know that can end up pretty poorly.
And one last question for you, and I know at Oxbow we've worked, one of our big pieces we've done the last 25 years, 30 years really, is work with business owners after they sold companies. But I have to tell you, Julian, looking at 21, I've never seen the prices paid for private companies, and it makes you wonder when private equity finally comes back and has to do some liquidating, what's going to happen, because they've overpaid for a lot of things, and every family office, wants to have alternative investments, but they don't understand the liquidity side of that, okay?
Right.
When you get in bad times. I'm curious of what you think about how that will play out.
I'm quite worried, because I think if you look at the average wealth portfolio, family office portfolio, it's probably 50% illiquid. And, if you look at the events, say in the UK, essentially what you saw was a margin call. You saw a bunch of insurance companies that had got into a situation where actually structurally higher rates were good for them, but the structures that he put in place demanded a margin call. And the margin calls happened very quickly, and they didn't have the cash to hand, so they had to go and sell an asset. And what they sold was more bonds, right, or gilts in the case of the UK. And that in itself perpetuated the sell-off, right, and the problem. The same thing I fear could happen with private offices and wealth. As I said, they're being constrained by cash calls coming from private equity that they've already committed to and the plans that they've already committed to. They don't want to sell their housing and their properties because they're not going to get top dollars for them if they can even sell them. And they've all gone and bought things like private jets on the back of these, to take advantage of the accelerative tax depreciation. And now the risk is that asset prices start going down and they get margin calls on those security-backed loans. What will happen? We kind of know what will happen. They will get called on their securities if they can't meet the cash calls.
Well, I have to say, and I know this business well, but you have got as good a handle on it as anybody that we ever talked to. I mean that sincerely, and you're so interesting. We could talk to you for a lot longer, but I want to thank you very much. And as all of you know out there, during the interview, you've seen a way to get in touch with MI2 partners and also take their services. You'll see this at the end. But Julian, I want to really thank you so much for taking the time to visit with us today. I appreciate your knowledge, and thanks for being with us.
Absolute pleasure. I hope this goes out at or people watch this later in the evening, so at least they can have a drink to dull some of the senses. And please do understand that I'm not a perma bear. I do just think this is one of the times when you need to be extraordinarily careful.
Well, I've read you over the years, and you've been long yep. The market, so they have to know who you are. But listen, thanks again, and we hope to see you again next year.
Pleasure, sir.
All right, thanks.
All the best.
You bet.
Bye-bye.